The top business stories live from the Sky News City studio. Payroll problems. Fewer jobs than expected were created in the United States last month. We'll have the latest market reaction from London and New York as the pound hits a two-week high against the US dollar. And as the Financial Conduct Authority tells banks to do more to support savers, we'll be speaking with the chief executive of one of the UK's big challenger banks. Good afternoon, this is Business Live with Ian King. Fewer jobs were created in the United States last month than expected. It emerged this lunchtime, suggesting that the Federal Reserve's aggressive interest rate rises this year are starting to dampen hiring activity. Well, the non-farm payrolls data revealed that US employers hired 209,000 people last month. That was lower than the 225,000 that Wall Street had been looking for. It represents the lowest monthly gain in US jobs since the pandemic. Well, the numbers for April and May were also revised downwards. It's now thought the US employers created some 306,000 jobs in May, down from the previous estimate of 339,000. It means that 110,000 fewer jobs were created in April and May than were previously thought. Well, joining me now to talk about this is Mickey Levy, Chief Economist for Americas and Asia at Berenberg Capital Markets. Mickey, great to see you today. Is this proof for you that the US economy is losing momentum?
It's slowing a bit. So there's no question that the pace of job gains is slowing. But let me take a different angle on it. By every measure, labor markets are still growing. I mean, 209,000, that year over year, employment's up 2.5%. The reason why it's still increasing is businesses see reason to hire people to produce because product demand is still there. So my assessment is labor markets remain strong, but slowing. And I think the surprise has been that employment has been continued to grow so rapidly and the economy has been so resilient. So let me put a positive tone on the interpretation.
So, well, it's a very interesting point you raise. I mean, it's worth noting that every single sector in the economy is actually still hiring, apart from tech.
No, that's right. The job gains are pretty evenly spread. Construction, manufacturing, certainly leisure and hospitality, healthcare and social services, really across the board. And one would have expected that a 5 percentage point increase in the Fed funds rate over the last year would have dampened things even more. And once again, the surprise has been the resilience of the economy. And when we think about beyond the labor markets, housing has already had its quote unquote recession and is bouncing back. And earlier this week, we got auto sales for June that jumped up. And so things look pretty firm, although I would expect now that the Fed has raised interest rates above inflation, unlike in the UK or Europe, that we would expect some moderation coming with a lag in here.
One of the characteristics of the labour market, Mickey, and the reason it's so tight in the US partly is because the labour force participation rate is still lower than it was going into the pandemic. Why do you think more Americans are not rejoining the labour force?
Oh, yours is a great point and question. It's really interesting to look at the composition because, as you point out, the overall labor force participation rate is below pre-pandemic levels. However, for prime-aged workers aged 25 to 54, it's already well above what it had been. The biggest shortfall is in older people who, for one reason or another, decided to retire early or temporarily step out of the labor markets, and a lot of younger people. So for prime age workers, the participation rate is well above where it was prior to the pandemic. It's very interesting.
Yeah, similar situation to the one we have here in the UK, actually. Where does this leave the Fed, then, in terms of future interest rate rises?
Well, the Fed will raise rates at the next meeting. That'll lift it to a target of 5.25% to 5.5%, which once again puts it moderately above inflation. then I expect it will pause. The problem the Fed faces, similar to the Bank of England, is inflation, while in the US has come down, the headline, core inflation, excluding food and energy, have remained sticky high. And so this is the Fed, having made so many mistakes, now sees the need to raise a little bit more, slow demand, and try to push inflation down. So one more hike, and then I think it pauses and waits to see the lags of its policies and its impact on slowing demand.
Yeah, worth noting that wages grew by 4.4% during the month, third consecutive month running. I mean, the Fed will want to see that lower, won't they?
Well, maybe not lower, but once again, you're bringing out a great point. If you take the combination of the job increases and the 0.4% increase in wages, that means disposable incomes continue to rise rapidly, supporting continued spending. And so, yes, the Fed needs to see slower demand growth in order to achieve its lower inflation. The issue is the lags between monetary policy and the economy. So the Fed will hike at least once more, then probably pause and try to wait. But the bottom line is, with inflation remaining sticky high and the economy resilient, it's highly likely that the Fed will keep rates higher for longer and be very slow to reduce rates.
All right, Mickey, we've got to leave it there. Always great to talk to you. Thanks for joining me today.
Thank you.
Some other stories making the business news this afternoon now. And house prices fell last month at their fastest pace in 12 years, according to Halifax. The UK's biggest mortgage lender said that year-on-year house prices fell by 2.6%. Halifax said that represented the biggest fall since June 2011. Well, the decline came on the back of a 1.1% fall in May and marks the third straight month of declines. Halifax said the rate of decline reflected the historically high house prices seen in the summer of last year, when prices were rising at more than 12%, supported by the temporary stamp duty cut. Average house prices are now falling on an annual basis in all parts of the UK, apart from the West Midlands, Yorkshire and Humberside and Northern Ireland. Shell warned today that trading at its gas division during the 3 months to the end of June would be significantly lower than in the first 3 months of the year. Company, which blamed seasonal factors, said the outturn in the division would be in line with the same periods in 2021 and 2022. It also said that oil and gas production during the quarter was down on the first 3 months of the year. It said it produced between 1.7 and 1.8 million barrels of oil equivalent a day during the period. That was down from 1.9 million barrels of oil equivalent a day in the first quarter. Shell also said that it would be making write-downs of up to $3 billion during the quarter. And JD Sports said today it will pay €500.1 million to take full control of the Spanish sports retailer Iberian Sports Retail Group. JD already owned just over 50% of Iberian Sports Retail, which currently operates more than 460 stores across Spain, Portugal and the Netherlands, as well as a half share in a fitness equipment business. Well, Regis Schultz, JD's chief executive, said that by bringing the two businesses together, there was significant potential for accelerating growth. I can tell you the shares have risen by 2% on that news. Now, regulators have warned UK banks to act more quickly in passing on interest rate rises to savers. The Financial Conduct Authority met with 9 lenders this week to urge them to do more. The high street banks have been accused of being quicker to raise mortgage rates than savings rates. Well, the FCA said after the meeting that the banks had recognised they needed to do more to help their consumers access the best rates. Well, joining me now to talk about this is Mark Mullen. He's Chief Executive of Atom Bank. Mark, good to see you this afternoon. This doesn't look like the FCA is going to be tightening the screw in terms of greater regulation anytime soon.
No, well, they don't really have powers to set prices for banks. So I think they're really just trying to amplify or build upon the pressure that's been, we've been trying to put on them, but also the Treasury Select Committee, the Chancellor, the Prime Minister, and almost shame them into taking action to sort of pass on some of the rate rises.
The thing is, though, the banks are pretty well capitalised right now. They don't need to chase deposits in the way that perhaps once they did.
No, they don't need to do it, but you've got to try and make sure that you're supporting your customers in good times and in bad. And let's be honest, they can't lend to borrowers unless they've got savers. So it's meant to be something of an equitable distribution between the benefits you pass on to a saver and obviously the prices that you charge to a borrower. And in that context, of course, savers have had a pretty terrible time since the global financial crisis. And don't forget, some of these banks were bailed out by UK taxpayers through the global financial crisis. So now that rates have been rising very steeply in the last year, you'd have sort of expected them to have done more, and almost by way of saying thank you for your loyalty and for sticking with us, to have passed on some of the profits, but they just haven't done that.
Now, the average savings rate right now on a typical easy access account is around 2.43%. What are you offering savers right now? I'll give you a chance to get a plug in.
No, we're offering 3.95%. So we're, and for the last, for half of last year, we had our instant access saver in the top 5. And for 47 out of 52 weeks last year, we had our fixed rate savers in the top 5. And we're a small bank relative to some of these big banks. And they're supposed to be able to use their scale to create advantages for customers. But we're just not seeing it.
What are you seeing, though, in terms of deposit inflows? I mean, that is an appreciably higher rate that you're offering savers. Presumably, you are seeing a fair amount of deposit inflows.
Yeah, we are. And so our deposits have grown by many billions, actually, over the last 12 months. But the reality of it is that attracting deposits really is about lending, right? And your ability to lend, if you're a bank in the UK, is driven by more than just deposits. And so, we're arguing for a more even playing field to allow competitors like us to actually put those deposits to work, not just for the benefit of the savers, but for the benefit of the mortgage borrowers as well. And let's be honest, mortgage borrowers are under significant pressure as well, as we see interest rates go above, the actual rates that are being charged go above 6%.
I've seen it argued that, particularly by the big 4 lending clearing banks, that people are best off advised, if they're looking to shop around, to go for a notice account, tie the money up for a year or so, rather than in an instant access savings account. Why do you think more savers are not doing that?
Well, it's a luxury that you'd want to have, right? So half of UK deposits, about give or take 1.9 trillion pounds of savings in the UK sort of personal savings market. Half of it is in sight deposits or instant access type accounts. And that's merely a reflection of the fact that people don't have the luxury of being able to lock their money up for a year or 2 years to be able to maximize the savings rate. And that's the line that the banks have come out with, which is lock it up for longer and frankly, we'll give you more interest. But it's an inflationary environment where people are under financial pressure and they need access to their money. And that's exactly how they're saving. So I just don't think it's fair. It doesn't recognize that people are actually living their lives. If you have £10,000, if you're fortunate enough to have £10,000 in savings, and you put it on deposit with the best interest rate for an instant access saver in the UK today for 1 year, then you're going to earn £350 in that year more than you're going to earn if you put it on deposit with one of the big clearing banks. And how is that justifiable? Why is there such a very, very big difference, given, as I said, that they've got market dominance? And the answer is that there's just not enough competition, because it's not the only sector where we've seen monopolies lead and lag. So sit-on benefits, we saw it last week in the forecourts with petrol retailing and retailers, and we see it in banks all the time. So really, you've got to encourage customers to vote with their fingers and move their money to a better savings bank. And remember that you're still protected to the tune of £85,000, regardless of which UK bank you save with. So it doesn't matter whether it's big or small. If it's a regulated bank, your money is safe.
You've put your finger on an important point there, Mark. I mean, one thing that I have seen commented on a lot lately is the fact that some savers may be a bit wary of going to a challenger bank because they remember what happened during the financial crisis, and the likes of IceSave, who are offering very competitive market-leading rates, blew up. And accordingly, people are sort of cleaving to the likes of Barclays and NatWest a bit more.
Yeah, it's an interesting point, though, isn't it? The global financial crisis wasn't caused because small banks got into trouble. The global financial crisis was caused because big banks got into trouble, and some of the biggest banks that got into trouble were RBS, now named NatWest, which is still 40% plus owned by the taxpayer, by you and me, and indeed Lloyds Banking Group. So I think that there's a perception that small is riskier, but the reality of it is that you ended up paying for the failure of banks that were, vast companies. So remember that £85,000 applies to all banks. And no bank is in a position to guarantee the safety of your money beyond £85,000. Go and ask HSBC or NatWest or Lloyds whether they will guarantee your deposits beyond that limit, and they will say no. So the reality of it is that if you're saving with a UK regulated bank, because we're part of the Financial Services Compensation Scheme and we're licensed, your money is safe up to £85,000.
All right, Mark, we've got to leave it there. Appreciate you joining me this afternoon. Thank you.
My pleasure.
Still to come here on Business Live, we'll have a look at the markets and how they've taken the US jobs data. Stay with us.
There's been a survey conducted, which Barclays did, which interested me, because it showed that while 3/4 of people wanted to make their homes more energy efficient, there was a big misconception about both the time that the works took and the cost. They thought it was much more expensive and much more disruptive than actually it is. Barclays the scheme's been very popular. They've got a greener home reward scheme, and they are offering their existing mortgage customers up to £2,000 to retrofit some of these environmentally friendly things. So it's solar panels, it's insulation, it's ground source heat pumps, it's double or triple glazing. So these are all things that are really good for the homeowners. They're really good for the environment. And actually, they're also very good news when it comes to selling. I think particularly now, anything that puts money in people's pockets or saves them money, and Barclays are offering up to £2,000, then that's also good news. In my last home, I had it all draft excluded. I had it tested and realised where I was losing heat. But actually, my current home, my predecessor had put a ground source heat pump and solar panels in. So that was a real comfort to me when I came to choose it. But I knew it generated money. Actually, it saved money. It's really well insulated.
It's a good selling option, is what you're saying.
It is, and increasingly so.
A lot of action going on. I'm Alex Crawford, and I'm Sky's special correspondent based in Istanbul.
This is what makes the job so fantastic.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. It's like Emirates, it's like better.
Well, the US dollar has slipped on the foreign exchange markets this afternoon on the softer than expected jobs data. The pound is at a two-week high right now against the greenback, up nearly 0.75% against the dollar so far today. It's also ahead by around 0.5% against the euro. The single currency, meanwhile, up by 2/3% against the dollar. Well, stocks in Europe have recovered most of their losses from earlier in the session. On those figures, the jobs data, of course, lifting hopes that the Federal Reserve may raise interest rates a little less aggressively than expected. You can see they're only the IBEX in Madrid right now, finishing up in negative territory. Talking points in Europe this afternoon include Clariant, the Swiss specialty chemicals company, is ahead by nearly 5% following a trading update. Here in London, the FTSE 100 has finished in negative territory. It's come off by a third of 1% or so there, down some 23.5 points on the session. It earlier on in the day hit a fresh three-month low on the back of weakness in healthcare and utility stocks. The biggest blue chip faller in percentage terms is RELX. Couldn't really find a reason why that one's off today. I'm sure someone out there will have an idea. Leading the gainers, the bottle of Coca-Cola HBC is ahead by more than 3% after raising its full-year profits forecast. Outside the FTSE, OSB Group, that's the owner of the buy-to-let mortgage lender One Savings Bank, has fallen by 26% on a profits warning, which has dragged down the specialist mortgage lender Paragon some 2% in sympathy. Among the gainers, the specialty chemicals group Elementis has finished up by just over 4.5%. It got a push from one of the brokers this morning, while YouGov is ahead by some 3.5% as its proposed acquisition of GfK's consumer panel business. It's a deal first reported by Sky's Mark Kleinman, has been well received. On Wall Street, well, the main indices have been pretty mixed on the back of the payrolls data. There's not a lot going on among them, in truth. Among talking points in the US, Levi Strauss has fallen by some 6% today after the jeans maker cut its earnings forecasts after the market closed last night. The oil price has picked up a bit as the day's gone on, following a bigger than expected drawdown in US crude stocks. A barrel of Brent crude will currently set you back $77.74 a barrel. That's up just over 1.5% on the session. Well, joining me this afternoon is Farhad Kamal, Chief Investment Officer at SG Kleinwort Hambro. Good to see you.
Hello.
What did you make of what Mickey was saying earlier on from the US on the jobs data? Because he was kind of pointing out that this still feels like a pretty resilient number.
Yeah, I think he was effectively arguing for what is known colloquially as the soft landing, which is that somehow, despite this incredibly aggressive tightening in monetary policy to the tune of 500 basis points, as well as tightening on the Fed balance sheet, you've got a system that's carrying on reasonably okay. Job growth is very strong, wage growth is very strong, people are out and about consuming as if there's no problem. And that really is sort of where the consensus is shifting slowly over the course of this year. We began the year very pessimistic. It's been better than we expected, and now it looks like that may well just carry on.
Yeah, but I mean, on that basis, though, is this sell-off in the dollar a bit overdone this afternoon?
Look, I mean, any particular one-day sell-off is not to be taken too seriously. The more important thing is the trend. The trend undeniably has been towards sterling this year. Obviously, sterling has been on a massive tear, up about 5 or 6% over the course of this year, and that is directly reflective of, ironically, a more tough situation than we have in the UK. Our monetary policy has to be a lot tighter because our inflation is much more intractable and difficult, and it requires a bigger dose of policy to get it right.
Yeah, no, it's been a hell of a week on the bond markets. We've seen big spikes in UK gilt yields, US treasuries, German bunds. Where does it all end?
Great question. I wish I knew for sure, but it does appear that clearly that in the U.S. anyway, monetary policy tightening is near an end. I don't expect to see the U.S. bond market yields go up too much from here. The U.K., as I said, we're still in an unknown paradigm. Are there going to be 2 more rate hikes, 3, 4? The market's not sure. Having said that, I do think, famous last words, that somewhere around the 4.5% on the 10-year yield, roughly where we are now, is near the top. Because clearly, at some point, if rates keep going up, we are going to have a tough economic situation. And in that time, rates will come back down again. So call it 4.5 to 4.75, the peak. and don't catch me out if I'm wrong.
I would never dream of doing that. I mean, there are implications here for UK government borrowing costs as well, of course. Never forget that.
Of course there are, and that is going to become an increasingly important part of budgetary calculations. For a long time, a decade, we didn't even consider it. We had a much higher degree of borrowing, but a much lower amount of interest spend because the rates were so low. That paradigm is gone. Now we have to be very, very cognizant of how much of our overall budget is being spent on interest. More and more of it is going in that direction. And, and that's just another hurdle for policymakers to contend with. Yeah. But it is a new challenge.
And the Bank of England not mopping up any supply anymore, are they?
No, in fact, quite the opposite. They're actively reducing the size of their balance sheet, putting bonds into the market. One of the reasons that we as a House were low duration to start this year and until very recently is because we knew a lot of supply was going to come on, partly from the Bank of England.
All right, Fahad, got to leave it there. Great to see you this morning. Thank
Always.
you this afternoon. That's it from me. I'm back on Monday with Business Live at 11:30. Hope very much to see you then. In the meantime, have a great weekend. Thanks for joining me today. Cheerio.